Welcome back for another edition of Real Estate Roundtable. And joined again, I'm Rob Moore with Echo Properties, and we're joined by the owner, Echo Lichtenstein, Jeff Lichtenstein, and our very special guest today, Ryan Brown from Cross Country Mortgage Palm Beach. Ryan, how you doing?
Doing well. Thanks, Rob. Thanks, Jeff.
So,
Hey, Ryan, I hear you're in the car today because you've been quarantined from the house.
I'm quarantined right now from my little children running around and screaming. So, yeah.
so Jeff, we're going to learn about.
Mine are upstairs right now sleeping. So
are mine.
I'm all right.
Mine are both sleeping right now. It's nice when they get a little older; they like to sleep a little longer.
The teenagers and they sleep a lot longer.
So we're going to talk about record low mortgage rates. We're going to talk about a lot of different stuff when it comes to mortgages. So Jeff, let's get started and learn a lot more from Ryan Brown.
So Ryan, why don't you tell us, Ryan, I've known you a long time. You've been doing this for a long time. I know you started years and years ago with credit repair, even going back, doing some of that work in the early 2000s or late 90s. And you were past president of the Florida Association of Mortgage Professionals. Tell us a little bit about your background and what you and your company have to offer.
Yeah, absolutely. Thanks again, Jeff, for having me on today. So, yeah, I've been in the business about 17 years now. I originally got introduced to the business through, I used to have a credit repair company back in the day, and back when it worked a lot better than it does now, but helping people increase their credit scores so they could get mortgages. And one of my jobs was to call on mortgage professionals and get their referrals or get their turn down. So that's kind of how I got introduced to the mortgage business. And like I said, been in it 17 years now. So it's an amazing business. I love helping people get into homes, helping complicated situations, either with credit or otherwise, and just get a lot of reward out of it. But yeah, I represent Cross Country Mortgage. I have a big office here in Palm Beach Gardens, 5,600 square feet right on North Lake Boulevard. We have about 30 people on our team there, and we're a direct lender. So basically what that means is that we will underwrite and process and close everything in-house, basically the same way the banks do it, but all we do is mortgages. That's all we do. So typically our rates and terms beat the banks, and we close a lot quicker and a lot less red tapes than the banks. So that's our primary competitor, no middleman. We sell direct to the government agencies.
And what's going on right now with rates in general? Rates, I hear oil dropped and they're giving you to take the barrel of oil away, but they're not too far from that. What are the rates?
So interest rates are absolutely incredible. They're at the lowest levels in all of history. So I believe they started recording interest rates back about 40 years ago. So in that time frame, they've never been this low. So for the first time last week, we've been talking about this for months now, that we felt that rates could dip below threes on a 30-year fixed, and for the first time last week, for certain credit profiles, of course, they dipped below a 3% on a 30-year fixed, 2.875, which is absolutely incredible.
And could they go lower even?
It's hard to say. The thing is, the reason rates are so low right now is that the Federal Reserve stepped in, I think this was back in February, and they decided to purchase all the mortgage-backed securities. And so if it's any type of government loan, which is your conventionals, FHA, VA, any of those type of loans, the government is basically purchasing all of those securities when they come to the marketplace. So in essence, what they're doing is subsidizing the mortgage rates. There's no public auction anymore for mortgage bonds. They're basically buying everything. So that's forcing interest rates down.
And what's going to happen? There's right now, there's been this, we're talking to Will Dean about mortgage. Right now, there's been this moratorium on mortgages where there's been no evictions and people have been delaying their payments and been printing a lot of money. So do you see interest rates going up at some point? I mean, I would think have to.
Yeah, absolutely. I mean, they are definitely going to go up. We just printed, $3 trillion, and I know we're going to be printing a lot more with some second rounds of stimulus. So, that is going to cause inflation at some point. Right now, there's no inflation. It's incredible. There's no inflation in the market, no signs of inflation. But it's just basic economics. It will happen. We will have inflation in mortgage rates. Inflation increases mortgage rates. So if you think of a mortgage rate or a mortgage, it's pretty incredible that you can lock in the value of money for literally 30 years at a certain rate. And you can control an asset for 30 years at a certain rate without it fluctuating or going up or going down. So as the value of money goes down, or you have inflation, the fixed assets, the value of those going up or the value of the money going down, you're literally fixed in. So that's the beautiful thing about purchasing real estate right now, is that you can literally, if you're getting a 15-year fix, you can literally get a rate like around 2.25. I mean, you pay a little points, you can get around 2. It's pretty incredible.
And I think it's also, even if you don't need the money, it's so good to have, because if interest rates go up later on, and then you do need the money later on, it's, that product doesn't become available.
Yeah, absolutely. So we're seeing a lot right now with high net worth individuals that typically would pay cash for a house. So typically, if they're buying a $2, $3, $5 million house on Jupiter Island, they would just pay cash. Now they're looking to get leverage on it, because if they can get leverage on it for such a low rate, and they can make the margin in the market. So let's just say in the market they can get 7%, but they're locking in at like a 2.5. On several $1 million, that's a lot of money per year that they're saving. So you're seeing people that wouldn't necessarily get mortgages, and then you're also seeing people doing cash out refinances out of their homes, whether they're free and clear or they have a lot of equity, and pulling cash out of the home because they can fix it at such a low interest rate.
Well, there's so much remodeling going on right now. There's the amount of impact glass, being put in, or hurricane-related things, or people are doing things because they're spending money at home that's in there, or some people need the dollars, from it, from loss of, revenue and things like that. How strong is the refinance market?
So refinance market it's incredible. It's super strong. So two sides in that. You have either people looking just to lower their interest rate. So that's called the rate and term refinance, where we just lower the rate and keep them at their same term, or go back to a 30, or we reduce the term. So you've seen a lot of that happen. So if somebody bought last year, they probably have a rate around 4, 4.25, and now we're dropping them in, to around 3 or less. So you're seeing that, where people just want to save money. You're also seeing people go from a 30-year term down to a 15-year term. So maybe they have a 30-year fixed right now at 4.25, but they can drop into a 2.25 15-year fixed. So what happens is you can literally shave 10 to 15 years off your loan. And since you're dropping so much in rate, maybe your payment stays the same, maybe it goes up $100 a month. But think about it, every month when you make that payment now, the majority of it's going to principal, and you just start creating equity that much faster. So that's the rate and term refinance. We're seeing a ton of those. And then as far as cash out refinances, we're seeing a lot of those as well. That's basically where you refinance and you pull equity out of your home, typically up to 80% maximum. So people are doing remodels, like you mentioned. One of the things I like to warn people about is anytime people go to get these impact windows or roofs, a lot of times the people will sell these PACE loans. And so a PACE loan is like it's a really easy loan to get, where you can basically finance in the cost of any improvements to your home. If they're going to make, like lower your payment on your electric, like if there are any energy efficient type improvements, you can get these PACE loans. The problem is, if you're going to put in $90,000 in hurricane windows and a roof, the PACE loans, the rate on those are like 6-7%, and they roll them into your real estate tax. So the smart thing to do would be to do a cash out refinance. Just use your equity as long as you have it, and get a really low interest rate, 2s and 3s, and not use those PACE loans. They're super expensive. So you're seeing a lot of that going on.
Are you seeing much, Ryan, with are they getting harder to get loans right now? Are the lenders being more restrictive and looking at what your are they being tougher on your job security, on what your credit score is, et cetera?
Not necessarily credit scores. I mean, there are new, we call them COVID guidelines that were set by the GSEs, and every lender is different. Every lender has their own set of basically they call them overlays, but they're guidelines on top of the regular government guidelines. So in general, they haven't been that much more restrictive, but certain lenders have instituted more restrictive guidelines just to slow the flow of new clients. So as an example, one of the big national banks, I won't name their name, but actually two of the big national banks, they instituted a new guideline where like literally you can't even get a loan there unless you have a 700 score and you have at least 20% down, and they won't even talk to you. I had a client just call me the other day. He called up the bank, and he had like a 680 credit score. He's still doing 20% down, but he said they literally hung up on me. I was like, wow. Mm-hmm. And he has, he has his business accounts with them and everything else. So yeah, you're seeing that. But in general, the COVID guidelines would be more centered around income. So as an example, as you can imagine, we have to verify ability to repay. So if you are, Jeff, let's just say you're working for, FPL as an example. You're working for FPL, and let's just say FPL had furloughs. I mean, maybe your income is the same, maybe it's different than it was in previous years. We have to verify what your current income is, that it's stable, that it's going to remain stable. So those are the things that we really have to check in. If you're, so what we have to do is 3 days prior to closing, within 3 days of closing, we have to call your employer and verify that you're still employed there and that nothing has changed in your profile as far as your income and hours. When it comes to self-employed, the biggest thing there is that for all self-employed clients now, we need a year-to-date profit and loss statement. So we have to verify that your income is basically tracking for what it did in 2019. And one of the issues we're seeing there is that sometimes we get these P&Ls and they show the PPP loan, and you can't use the PPP loan towards your income, so you have to back that out.
That's interesting.
So there's kind of certain things that are going on with those, but it's more centered around income and employment.
What's happening in terms of COVID? What I know at one time, and I assume they still are, they're doing appraisals or not even entering the home. Is there any verification of looking at what the remodel is or what the house looks like inside?
Yeah, for certain circumstances, the appraisers are allowed to do just a drive-by appraisal. But we are seeing more appraisal reports do have to go into the home. So if they're higher LTV loans, or if it's a refinance where they're taking cash out, or if their current loan isn't owned by a GSE, then the appraiser has to enter the home. But I mean, all the appraisers now, I mean, they wear gloves, masks, the shield. They don't touch anything. They walk around, take a couple photos, and they're out. So,
are you running into problems with comps because prices have been going up?
We haven't been running into too many though. I think if the appraiser that is selected knows the local market and they understand it, they can adjust for it. So obviously, if there's no comps and the value doesn't support, the value is not going to come in. You're going to have an issue there. But most of the time, if you're working with a good listing agent like Jeff, I know you do a great job at this, where you list a home, but you don't list it where it's not going to appraise. You list it kind of at that top level to get your seller the best actual price. But if you have a good appraiser, the appraiser is going to bring that value in because they're going to understand the market and the demand. And they're going to discuss that with the listing agent.
Yeah, well, there's an entire art to appraising and where you can bring things in and how you can't and make sure that the appraiser, and part of what's really good about Ryan, because people don't really understand this, talk about what you do on the appraisal end, because you spend a little bit of extra dollars on that, but it's so worth it because your appraisals know what they're doing and you have control over it. Then.
Yeah, I mean, I have 5 people on my panel. So typically when you order an appraisal through any of your online companies, any of your banks, what they do is they take the money and they farm it out to these appraisal management companies. The appraisal management companies, they're in business to make the most profit. So if they're getting a $500 fee, they're going to try to find the appraiser who has the least fee. So they'll farm it out to an appraiser. Maybe that will take $250 or $275 on the deal, and they keep kind of that spread. Well, obviously you get what you pay for. I mean, the last thing you want if you're listing a home in Mirasol is to have some guy from Miami-Dade come up and appraise the property in Marisol because they're not going to understand it. Marisol, every little pocket's different. Every area is different. It's just, unless you're in the local market, it's really hard to appraise properties there. Just using that as an example. So I work with 5 guys. I've been working with all of them for over 10 years. They're the best of the best. They're on our private appraisal panel. So one of those guys get the report. We charge $5.95 for the appraisals, what we charge, and we have an agreement with our AMC where the appraiser gets the majority of that fee. So we get the best of the best appraisers, and it's just super important because you need guys that understand the local market, live in the local market. We'll actually take the time to talk to the listing agent and the buyer's agent. They'll take the time if let's say the value's not there or they're not seeing the comps, take the time to research maybe off MLS sales, public sales, and they'll also will do a rebuttal if they need to, So that's the value of having a private appraisal panel of all local appraisers.
And go through some other things that are going on right now. Can you talk about, you were talking about what your return of investment is, right now with lower rates and inflation, how to hedge against it.
Yeah, I mean, as far as return of investments, the beautiful thing about right now is if you think is from either from a primary residence purchase or a person as an investor, if you're buying an investment property right now, actually, let me back up. Let me just talk about purchasing as a primary residence. So let's just take an example. Buying a home for $350,000, or maybe $400,000. You're going to put down $50,000 or whatever. Anyway, let's just say you're going to mortgage $350,000. So a year ago, that would be your rate on that would be 4.25%. So the principal and interest payment on that would be $1,721. Today, you're going to be closer to $2,875. So your principal and interest would be about $1,452. So that's about $268 less per month. So the value of having these low rates is that now your payment's much lower. Or if you look at it from another standpoint, is if you're buying this $400,000 house, so you can literally you can increase your mortgage from $350,000 to about $410,000. So maybe you can increase your price about $65,000 and literally have the same payment you would have last year. So people look at.
And what would the payment be exactly? You go by a rule of 25,000. So explain that. Or I think it's for every time there's a quarter of a rate drop.
Yeah. Well, just like in this example, you're literally saving. You're able to increase your purchase price $60,000 more just by having the lower rate and keeping the exact same payment. But if you look at it from like a return on an investment standpoint, so let's just say that's an investment property, you're talking about a 9% more return on that property just from having a lower interest rate. So if you had a 4.25% versus a 2,875, the total return, you're looking at about a 9% increase, which is incredible. So you're seeing a lot of investors right now saying, maybe I should look at a duplex, or maybe I should look at a single family rental, because now you can actually cash flow on it, make money on it, fixing that rate for 30 years at that low rate. So it's making a lot more sense to buy investment properties now than it did just a year ago.
Right. And there's a lot of people, I was talking to Will, there's, some companies really looking to jump back into that in a massive way. And you're going to also have, on the flip side, you're going to have a lot of people, right now they're not paying their mortgage, or they've lost their job, or they're in a rent, and they're going to get thrown out of the rental for not paying the rent. So there's going to be a lot of demand for rental property in the investment market. And there's going to be great buys out there on the commercial side for all sorts of historic buys where you want to be liquid for either using it for commercial use or mixed use. So you may see some commercial properties. So you may be living in the mall or Pier 1.
Could be.
Yeah.
I wouldn't doubt it.
Yeah.
But I think you'll see some pressure on investors too. So like if you own a bunch of investment properties and you have some people not paying, maybe you're at the point where you're just kind of fed up and you're, wanting to dump those properties or get rid of them. So maybe you'll start to see more of that. I don't know. It'll be interesting to see kind of what happens over the next 6 months here.
Right. But on a long-term basis, well, I don't think we're going to see these rates again because we're going to have to pay back the trillions of dollars that have been out there. And anytime you print money, we've all learned in economics 101 that you eventually get inflation out of it. It just has to come. So that may not be for a while, but at some point it will happen. And usually the people who don't have mortgages, I remember in the, the 11 market, if you didn't have a mortgage, a lot of people were really upset about it, that they, I got penalized because I paid in cash. There's really great things to do and use money for all sorts of different things and save right now, lots because the rates are just ridiculously so low. The risk of having a mortgage is much lower than I think the risk of having cash.
I agree 100%. I mean, you can always pay off the loan. There's no prepayment penalties on loans anymore. So take the money in 6 months or a year, if you need to pay it off, pay it off. But
are you seeing? Are there any mortgages right now that are doing where you can transfer it?
No, I mean, the VA is the only one that's assumable, but it's like VA to VA.
Yeah, because that could be really a valuable tool down the road. Why did they do away with that? Is that because of what happened in the 80s?
Yeah, I think so. Yeah.
We had 20% interest rates and stuff like that. Really interesting.
I was going to say, even on the VA assumables, you still have to qualify. I mean, yeah, it'd be great. Like if you could sell your house with a loan with 2% on it, that'd be a big value to somebody buying it in the future. But lastly on rates, I would just say, listen, this is like, we've never seen this in all of history. Like, I don't know if people understand this. Like, we've never seen this, and we're probably never going to see it in our lifetime. A 2% rate on a 15 or in the twos. And we're going to look back on this period and be like, oh my God, Jeff, do you remember when like rates like hit 2.875? Like, we're going to be talking about this in the future. So I would say we have about a 6-month window. So like if you or anybody that has a 4% rate or a 3.875 or higher, they need to refinance. Give us a call, give whoever a call, but you got to refinance the loan. There's no reason you should be paying a higher rate. And if you're thinking about buying something or upgrading, now's the time to do it because you can upgrade and literally your payment's probably not even going to go up that much because rates are so low. So buy it. If you're thinking about buying an investment property, buy it now because you're going to get the return on investment.
Yeah, and if we were talking to Will earlier, there's also we have multiple areas of pent-up demand that are building. There's one area that is in the rental market of people who are renting and want to buy, or there's going to be this investment property thing where you're getting renters who are going to get kicked out of their place and are going to need somewhere to go. You're also getting into, there's a pent-up demand of people up north that may be in the Midwest, that's tons in the Northeast, and definitely you've got some issues in Canada. We've got also people in our particular market moving from Miami and Fort Lauderdale want to be out of urban environments. So the pent demand, especially from the Northeast or Chicago in the Midwest or Ohio, where people can't get down here right now, and once we get to season, we've got a laundry list of people looking to come. So that's going to have an effect on prices as well. So I see a lot. I think we see a lot of different things going on. In the residential market, and the mortgage market fuels a lot of what happens in everything.
Yep, absolutely.
Ryan, what is your contact information and your website? And Rob, can you put that both later on the blog? And would you please put it on the thread on Facebook as well?
Yep.
Yeah, best way to get a hold of me is website is just Ryan D as in David Brown.com. So RyanDBrown.com. Rob can put the email underneath, and you can always call me on myself, 561-707-0277.
Ryan is very responsive, and he's got a very deep, strong team who's been with him. They have really good synergy, together, and he knows his stuff. Creative and responsive, and he's local and understands the local market. And you get all sorts of problems right when you get to closing sometimes, and when the HOAs, the area, and you're not getting some call from somebody in Rocket Mortgage in Minnesota, is in a call center, it makes a world of difference.
And Jeff, I could say,
And the other thing is, when people sometimes they shop their own banks, Ryan is not limited. He has so many sources of places he can shop a loan, to. There's just a laundry list of it. So there's all sorts of reasons there to do it, and they're really well, financed cross country. It's a terrific company.
and Jeff, I could say I'm getting help from Ryan's team right now, looking to refinance my home, and they've been nothing but exceptional and helping me, my credit, help my credit score. So I'm building that back up to where I can, refinance at probably a lower rate. So Ryan, your team's been great. They've been in constant contact, and I'm almost there. I'm ready to do it. So I appreciate the help from your team.
You're welcome. Thanks, guys, for having me on today. And Jeff, I just love what you and Rob are doing. What you're doing as far as getting information out and staying consistent with the information. And I just think you're doing a great job. I have a ton of respect for you, and I appreciate our relationship and all the things that we do together. So thank you.
Thanks, Ryan. Well, go back to sleep.
Go back to the kids.
Yeah.
You go back to the kids. That's right.
No sleep
All
when you
right.
have little kids.
I forget those days. But it's one of the nice things about this period of time is we have dinner every night, together as a family, and it's a really neat thing. We take out from one lady right now who does she's like in her home makes Indian food. That's like that's our Saturday night meal, and so there's different things that are going on with this whole thing, and I think some of it, like we were talking about looking back, there's going to be some good parts of this too, with all despite all the negative parts of it.
Blessings for sure. Yeah.
All right, so that ends this edition of Real Estate Roundtable. We'll be back next week. So for myself, Ryan Brown, and Rob Moore, so long, everybody.
See you guys.
See you later.
Bye.
Thanks, Ryan.